Hi, everyone. We're just going to give it a few more minutes here. Give everyone some time to get logged in. Good morning,
Andrea.
everyone. My name is Andrea Seminelli, the Marketing and Business Development Manager for Adam Global Network. Welcome to today's webinar on transfer pricing methods, brought to you by Mr. Abbas, CPA and partner at Adam Global Advisory. With over 22 years of industry experience, with a network of over 200 global advisors and a team of chartered accountants, we at Adam Global are dedicated to empowering your business success. From VAT and corporate tax support to internal and external audits, bookkeeping and business planning, we provide comprehensive solutions. Now, without further ado, let's get into transfer pricing methods.
Thank you very much, Andrea. Good morning, everyone. So today's topic, as we all know, is transfer pricing methods, right? So we're going to do a bit of recap, right? And so last month, we had this webinar on why transfer pricing is important. Within that, we went through related parties. What are related parties? What is arm's length transaction? What are the transfer pricing documentations? And let's say if you are facing a transfer pricing audit, how to deal with it. These are some of the areas that we went through in our last webinar, okay? So if we go back to the same premise, the objective of our webinar, what was the objective of the entire webinar? Why do we need to know transfer pricing, why it is important, and the repercussions on our tax and compliance matters. So if you are in international business, if you have multiple subsidiaries, if you have multiple entities and they're dealing with each other, there will be a transfer of goods and services between the parties, between the related parties, and this is where we as stakeholders, we could be accountants, we could be auditors, we need to be aware of the implications, right? And we need to deal with the transfer pricing accordingly, right? So that's a bit of a recap. Today, we're going to go through the methods of transfer pricing, okay? So we have got 5 transfer methods which are internationally acceptable, okay? Because there could be entities where they would have their other entities or related parties located abroad in different countries, and this is where they need to choose the method which is internationally accepted. And if we look at Article 34(3) of the corporate tax law, that advises us to go for these 5 methods. These are the 5 recommended internationally acceptable methods, okay? So transfer pricing methods provide clear guidance for M&Es and tax authorities in determining the appropriate pricing of controlled transactions, right? So let's go through it one by one and see what are the 5 different transfer pricing methods, okay? And then we can decide which one is better for us, for your entity. Just to give you a heads up, once again, highly technical area, and one of my most important piece of advice pertinent to this area is if you are unsure, please seek legal advice. You know, we are here, expert advice needs to be taken, needs to be sought if you want to have the right way of doing it, okay? So let's go through transfer pricing methods. So the first method that we have got is the comparable uncontrolled price method, okay? CUP, comparable uncontrolled price method, okay? Let's look at the name. That's indicative of what it is. We're going to break it down, and that will help us a lot to understand what this method is, right? So comparable. What's the first word here? Comparable. So we have to make sure when we are comparing our prices, right? It has to be comparable. If comparability is not there, there is no way we can do it. We cannot achieve the purpose, right? Uncontrolled price method, we have to make sure it's uncontrolled, right? And to have an uncontrolled price method, we will be looking at internal CUP and external CUP, right? These are the two ways which are kind of subsections within CUP, internal CUP and external CUP, which would help us to come up with a reasonable price comparison, okay? So imagine you are selling your goods or services to an independent third-party vendor, okay? What is the price that you would be charging? Okay, so let's take that price, and then whatever price that you have already charged your related party, let's compare it with that, okay, and see how reasonable that price was, right? Now, the CUP method is the most direct way of ascertaining an arm's length price, okay? That's very important to know. It's the most direct way. It compares the prices charged for a property or services transferred in a controlled transaction to a price charged for a property or services transferred in a comparable uncontrolled transaction, right? Now, let's go through it one by one. Internal CUP and external CUP. So what is internal CUP? That's where you are comparing your internally used pricing that we have already used. You're comparing them with another entity. Okay, so let's say if your entity is providing these sales or services to another third party, which is independent, totally independent, and to our entity. Okay, we have got nothing to do with them in a way in terms of control. We don't have any control over them. Okay, and then compare them. What is the kind of price that you would be getting? Okay, so that's internal CUP. Then comes external CUP, right? External CUP is where you just keep your entity and your pricing aside, and you assume that the same transaction would have taken place, between the two totally independent parties. So both the parties this time are totally independent. They've got no influence, no affiliation with your entity, and you would assume that both are there. They have done the same kind of deal, let's say buying and selling of same kind of goods and services. What was the price that they might have used? That price will be compared with the price that you have used for your transfer pricing. And then what's the end goal? You have to make sure those prices are reasonable. They are at par. If they are not at par, it means the prices were either over or under, and they could have negative repercussions in terms of your tax liability, in terms of your compliance, in terms of your reputation, business continuity. So we need to bear all these in mind, and we need to make sure we are using it in a most reliable, independent way when we are comparing the prices, right? So that's comparable uncontrolled price method. Let's go to method number two. Method number two is the resale price method, okay? So RPM, the resale price method, okay? Very straightforward. We want to know if the price that we have used, if that's the right price or not, if that's in line with the market price. So as per this method, what we do is we will take the same product or service, the subject product or service, we will take it out into the market, and we will see what is the resale price, okay? So if we have used the right price in the first place, the resale price that we will be getting will be almost the same. It will be at par with our price, right? And that's one of the indicators that would be telling us the price that we have used for internally transfer pricing was reasonable and was at par. But if you're taking them out for resale and you're not fetching the same value, let's say, it means we have either overpriced it, or if the value is higher than what we have used, it means we have underpriced it, okay? And accordingly, we have to take corrective measures, right? So this is called resale price method, okay? Let's take an example for in-depth understanding, okay? So let's assume we bought 100 kg of raw material from one of our subsidiaries at 10,000 dirhams, right? 100 kg of raw material at 10,000. Now, if we take this raw material out into the market, and can we fetch the same price? Can we sell it outside for 10,000 dirhams? That's the question. If you can, it means that the price that we have used internally was at par with the market value. It was reasonable. It was acceptable. But if it's over or under, what does it tell us? It means there was something wrong with our price. And that's probably the reason why we cannot fetch the same price from the market when we are reselling it into the market. Okay, so one of great ways of getting that peace of mind in terms of suitability of pricing that we would be using. So once again, we have got internal comparable and we have external comparable. Okay, internal comparables are reliable, but external comparables are even more reliable. And that's because within external comparables, what you are doing is you're looking at the transaction as if it has happened between two fully independent companies where we do not have any sort of control on their pricing methods. Okay. So internal comparable, you will be comparing prices with with an independent entity, okay? And in external comparable, what you would do, as I mentioned earlier, both the entities, we would assume they're fully independent and we will be comparing their prices, okay? So that would tell us whether the price that we have actually used for our transaction, was that reasonable? Was that at par with market value or not, okay? These are the two ways that we will be looking into it, okay? So we have went through CUP, we have went through RMP, and the third method that we have got is the cost plus method, okay? CPM, cost plus method. Now, in the cost plus method, we take the cost incurred on producing the goods, right? Whatever cost it has that we have incurred, whatever cost, let's take that cost and add appropriate portion of profit on top of it, okay? Now, whatever the price you will be getting, okay, we will need to compare it with the outside market, okay? So in other words, what you're doing is you are saying that, let's say you have a desired benchmarked rate of return or profitability that you are looking at, okay? As a result of this sale, have you achieved that profitability or not? That's the question. That's what we are looking at, okay? So if the profit ratio is reasonable, that will provide obviously not absolute, but reasonable kind of assurance that the transfer price used was reasonable and was matching the market price, okay? So that's CPM. Now, CPM is mostly used where semi-finished goods are sold between related parties or connected persons, where related parties or connected persons have concluded jointly a facility agreement or long-term buyer supply agreement, okay? So what we said in the beginning was we're going to go through 5 methods of transfer pricing, and then in the end of the day, it will come to choosing the right type of transfer pricing. And this is very pertinent to choosing the right type of transfer pricing method. Okay, so if you are into business where, let's say, you have company A and company B, and we are company A and company B is our subsidiary, we buy semi-finished goods from company B, and then we turn them into finished goods and we sell them into the market. So the transfer price between company A and company B that we are using, right, for semi-finished goods, cost plus method could be a very appropriate method for those kind of entities. But once again, be very cautious. Make sure you seek expert advice because there are so many other factors apart from the nature of your business. There are so many other factors. It could be in exogenous variables which are involved there that you have to take into consideration while choosing the right kind of method. Okay. So that is cost plus method. So by now we have gone through CUP, we have gone through CPM, we have gone through RMP, and we are going to move on to our fourth method. All right. So the fourth method that we have got, which is again internationally acceptable and advised by our tax authorities, it could be one of the methods that we would be using is the transactional net margin method, okay? TNMM, the transactional net margin method. So what is TNMM? Let's look into it. So in the previous methods, we used gross profit, the overall profit, the suitability, reasonability of our overall profit, right? Whether it was okay, the kind of profit we were getting, was it in line with, let's say, an industry average, or if we were selling the same product to an independent party, or in one of the other methods we looked into, the cost plus method, we also took the cost into consideration that we would be aware of, right? And we added some level of profits. In this method, we will particularly emphasize on the net profit. I'm repeating myself, not the gross profit, not the overall profit, but the net profit margin. We will be looking at it. How much margins are we making? Are they reasonable? Are they aligned with the industry average? Are they aligned with our transactions that might have happened with an independent party? That's what we would be looking at, okay? So this method uses the premise of net profit margin that an entity has made from the related party transaction as compared to the profit margin that the entity might have made while selling the same goods or services to an independent third party, right? Now, the net profit method, once again, it focuses on net margins. Now, we as an accountant, some of you may not be purely accountants. For us accountants, we know we have got certain ratios available for our to find out the net profitability. So these are some of the ratios, some of the suggested ratios that we can use to find out the transactional net profit method. So one of them could be operating margin or return on sales. That's one of your first ratio. You can also look into net cost plus or full cost markup. That's another ratio that we can use. And thirdly, a very widely used ratio that we accountants are aware of is return on assets or return on capital employed. So these are some of the ratios that we can use to find out the net profit method. And again, once we find that out, all we have to do is align it with our business strategy and see whether that was reasonable or not. Does it give you a right kind of figure? Is it acceptable? You also have to look at both the parties, right? So if it's obviously the transaction was between the related parties, you have to make sure you don't just look at one side of the transaction. For example, we have buyers and sellers. Earlier, we used an example of company A and B. Company A is in UAE, company B is in, let's say, Egypt. And we had this buy and sale agreement based on which they have sold us certain items. So we need to look at the net profit margins that company A, which is situated in UAE, has made. Okay, and we also have to look at the net profit margins that entity B, which is situated in Egypt, has made. We have to take both of them into consideration, and we need to make sure that those are at acceptable level. It should make business sense, and that is how we can justify our transfer pricing policy, right? If we can move to the fifth one, please. And so profit split method, okay? So by now we have gone through CUP, we have gone through cost plus method, we have gone through RMP, we have gone through net profit margins method. The last method which is available to us, which is internationally acceptable, is the profit split method, okay? So if you could recall from my previous webinar, we used an example where the tax rate in one of the countries, other countries, was almost like negligible, extremely low. And in here, we had a higher rate. So within that example, what we were looking at as we would design the transfer pricing in such a way that could be tax efficient for a country where the rates are higher, but group-wise, the overall tax liability for the group would be reduced, but obviously that's not compliant with the tax authorities' guidelines, and we need to be cautious, and we need to make sure that is not happening. We are complying with the rules and regulations of the tax authorities of both the countries, right? So this is where this method really comes into play. So profit split method, the method that identifies the relevant profits to be split for associated enterprises from a control transaction, and then splits those profits between the associated enterprises on an economically valid basis that approximates the division of profits that would have been agreed at arm's length, right? So that's what it is. Let's say a transaction has happened, and whatever profits we have made, you would split it to make sure that if there is any such situation where the other entity, which is not prone to higher taxes, they might, shift the profits to that entity. So overall group tax liability can be reduced. That is not happening. And we need to look into the profitability, whether both entities situated in two different countries, whether they are getting a reasonable profitability from the same transaction or not. And that is how we would split the transaction, right? So these are the 5 methods which are available to us. Again, internationally acceptable, but you got to be very, very careful while choosing the right method, the most appropriate method. And so there are so many factors that we have to bear in mind while choosing the right kind of method, okay? There are a number of factors that I'm going to go through. But mind you, these are not all the factors that we have to be aware of. There could be so many other factors. And this is why I am advising again and again, if you have any kind of confusions, if you don't have enough clarity, if you have questions, please seek expert advice. And that will ensure your long-term compliance and your, when it comes to tax audits, it would be smooth sailing, right? So the number one factor that we would be considering is the alignment with overall business strategy and objectives, right? The pricing, is that aligned with your business strategy? The pricing that we are using, the method that we are using, is that aligned with your business strategy? Is that aligned with the long, short-term, medium-term objectives? These are the questions that we need to ask ourselves prior to choosing a method, okay? Reliability and availability of data. This is very, very important because when we talk about data, we are talking about supporting documentation. Mind you, we are subject to audits. And when it comes to audits, we are looking for sufficient and appropriate audit evidence that is derived from the data. So we have to make sure while choosing the method that the data that we would be using, first of all, it has to be available, okay, on consistent basis. And secondly, the data has to be reliable. So if the data is not available or if it's not reliable, it means we will be struggling. Okay, so this is something that you really need to be cautious of while choosing the right type of pricing method. Okay. Thirdly, how realistic is the comparison between controlled and uncontrolled transaction? Okay, so pricing methods, what are we doing? We are comparing. We are comparing our pricing with the external market marketing price, the prices which are available in the market, whether they are reliable or not, where they are at par or not. And while choosing the method, we have to keep in mind the realism, how realistic that it is going to be in the future. We need to bear that in mind, okay? We also have to bear in mind that we are comparing ourselves, let's say, with an uncontrolled entity and their uncontrolled transactions. Can we fetch that data? Would we be having access to that on consistent basis? That's very important. We have to also be aware of the legal requirements that could be pertinent to your country that you're dealing in. If it's UAE, you have to be aware of your legal requirements. Similarly, if it's another Gulf country, you have to be aware of the legal requirements within that country while choosing the right method. Simplicity and consistency, very, very important. Simplicity because you don't want to make it rocket science for you, because time is money. You have to make sure you're not wasting too much time on it. So it has to be simple in terms of adaptability and practicality. It has to be simple and adaptable. Consistency is super important. Okay, so we as accountants, we know there is a term called cherry picking, right? And we need to avoid cherry picking. We shouldn't be perceived as an entity who is not consistent and going for different pricing methods depending on whichever is, let's say, beneficial at that point. We need to have consistency there in choosing the right methods, okay? So once we know what's the right method for us, let's stick to that method, okay? And avoid cherry picking, please. That is obviously not desired by the tax authorities. We shouldn't be seen as if we are cherry picking. Flexibility and adaptability. Once again, the method that we are choosing, it has to be adaptable. We need to have right kind of resources, expertise, right kind of people, time to adapt that. Okay, so that need to be considered. All these factors. Flexibility is one of the other thing. It has to be flexible enough to be adapted as our pricing method. So these are some of the methods that we, some of the factors that we will be considering while choosing the right method. Once again, these are not all the factors that we should take into consideration. There could be many, many more factors, and it would really depend upon your circumstances, the type of entity, the country you are operating in, the other entities you're dealing with, the nature of your business. There are a million different factors that we need to consider. So at the end of the day, you need to make sure you're very clear and you're seeking expert advice while choosing the right method, please. Thank you very much. And Andrea, if you could please let us know if there are any questions, and then we can conclude it. Thank you very much.
Thank you, Abbas. Yes, we do have a few questions that have come through. First I have, can I use cost plus method for my business?
Okay. Look, it's a very good question, but a vague question, because we really need to know what kind of business you are in. What's the nature of your business? What are the operations? Are you involved in international operations, or is it within UAE? So it would really depend upon the nature of your business. Okay. Of course, there are a number of advantages that come with cost plus method. For example, it's simple to use. The price can be justified for sure. That's one of the other benefit, and it provides consistency. In terms of rate of return, that's always there. So these are some of the benefits that you can definitely take into consideration while using the cost plus method. But again, what we would highly advise is to make sure you seek expert opinion. It could be us, Adam Global. It could be another expert. Please make sure you're seeking expert advice, please. Thank you.
Wonderful. And then question number 2, which comparison is reliable? Controlled CUP or uncontrolled CUP?
Okay, so you have to look at the premise, okay? What's the premise? What's the objective? Why are we doing this whole assignment? Why are we doing all this? We are doing this because we want to justify it to all the stakeholders, including the tax authority, our management, accountants, auditors, any type of stakeholder. What we are trying to do is we are trying to tell them that the transfer pricing that we are using is reliable, it's transparent, and it's at par with the market pricing. Okay, that's the whole purpose. So when you say controlled CUP, right, and uncontrolled CUP, the higher the control, okay, let's put it this way, the higher the control, the lesser the level of independence. Okay, so therefore uncontrolled CUPs provide a higher level of independence and higher level of reliability as compared to controlled CUPs. Thank you, Andrea. Any other questions?
Yes. I have question number 3. Can we try different methods?
Okay. All right. So it depends on the intent. Okay. So as long as the intent is to find the appropriate type of method which is suitable, okay, reasonable, and that gives you the right type of pricing, yes, you can try them, but in the long run, consistency has to be there. Okay. You remember we just talked about cherry picking. So we shouldn't be perceived as if we are doing cherry picking, where we are picking and choosing whichever method is beneficial for us in terms of, let's say, tax saving time to time, and then the same method, if that's not cost efficient or tax efficient, we will choose another method. That shouldn't be happening. We need to have consistency there. That's for sure. So yeah, we need to have consistency that we have to take into consideration, please, while trying different methods. Try them, obviously assess them, but once you implement them, make sure the implementation is on a consistent basis.
Thank you for clearing that one up. And then the last question, and I do apologize to our attendees for those who have put in their questions if we have not had the chance to answer them just yet. But the last one will be, what are controlled transactions?
Okay, so we talked about related parties, right? And related parties are businesses where one business has certain level of control over the other business. Okay. Now the transactions that would be happening between these two entities, and the pricing which would be used while carrying those transactions both the entities would have certain level of control. Okay, so let's say, for example, you go out and you're buying something and you don't know the seller, right? You don't have any control over the pricing that you would be asked for, right? But when it comes to control transactions from emerging from subsidiaries and related parties, there will be some type of control over those transactions, right? And that's what we need to take care of. So that control should not be misused while setting the transfer price. Thank you, Andrea.
Thank you, Abbas. And thank you for this valuable information on transfer pricing methods. And I'd like to thank everyone who's had the opportunity to join us for our webinar today. And as always, for additional questions and concerns, and to become a member of our Adam Global Provider Network, we encourage you to reach out. Our contact details are below. Thank you.